Russell Burns, welcome. You have worked at places like Schroders, Credit Suisse and hedge funds. Now you're an analyst at Finimize. Welcome.
Hey, thanks for having me on.
Great to have you here. So today we're going to be talking about the biggest stories in financial markets right now. We're going to dive into precious metals, everything going on with gold and silver, and take a look across the Finimize ecosystem and how we produce our content. Let's dive right into it. What is going on in markets today? What's the biggest story people should be paying attention to?
I think the biggest story out there is rotation out of the US into international markets, and again, rotation from growth into value stocks.
Bring it home for us. Why should I care about rotation?
Well, it depends how you invest, but if you're in the US, the S&P 500 is dominated by global tech stocks, and it's outperformed the equal-weighted S&P 500, for example, by a huge amount over the last decade. And as this rotation's happening for finally an equal-weighted S&P, or value stocks are outperforming growth stocks. And that's we've waited a long time for this, as you said, a patient investor and all that.
Okay. Is there much in the rotation out of the US trade as well? Is that as big a deal as it seems it might be?
Yeah, I mean, last year, for the first time in like a decade or so, where international markets kind of outperformed the US, whether that's Europe or emerging. So yeah, this rotation has been happening for sort of in some pace. And it's not just value stocks, there's growth and tech as well, because this whole tech and AI trade is impacting stocks globally.
Fantastic. Gold and precious metals have been really interesting lately. They've had a bit of a wild ride of late. What do you make of all of it? What's going on there?
I mean, yeah, the move last year was phenomenal. Silver, 160%, gold around 65%. I mean, it was remarkable moves on any measure. I kind of consider them to be slightly different. With gold, the one different buyer out there via the rest is central banks.
Yeah.
Central banks have been picking up their gold reserves, bigger now than US treasuries. As you know, the world's changed with increased geopolitical risks. For silver and the other commodities, it is a different dynamic.
Right.
You've had a lot of retail activity and investment funds and a lot of leverage trading too.
Is one of those more sustainable than the other? Central banks aren't known for moving quickly, let's say, whereas retail investors probably are.
I think for sure. I think central banks are buying and they're going to be holding probably for 10, 15, 25, 30, 40 years. So yeah, we're not expecting central banks to be cutting those positions anytime soon. For the other metals, it's a different ballgame altogether. One thing that's really interesting with metals, it's very hard to value them. It's not like a company. And a company, you can do a DCF or an earnings. With a metal, it's like, or even crypto, it's what's this company trading at? How do you actually value it? And sure, there's implications for the world market, buyers and sellers of these commodities and whatever else. But in actual fact, what's the true value of gold, silver, platinum, anything? No one really knows for sure.
Exactly. I mean, with a stock, generally speaking, there's a stream of cash flow, a dividend that you can, hang your hat on and say, well, I'm paying now for this later. But commodities just don't give you anything, right? Crypto doesn't, in most cases, give you anything. And so you are speculating just on the headline price.
To a large extent, yeah, very much so, yeah.
From precious metals and gold to digital gold, Bitcoin and crypto. So what are your thoughts there?
What I still think is the biggest thing for the last 6 months with crypto is the threat of quantum computing, and the digital gold argument's fallen by the wayside. Yeah. Because if 30% of Bitcoin's vulnerable to a hacking, it loses any semblance of being digital gold. That to me is the biggest thing.
Yeah, that's so true. And what I find just interesting about the whole thing is, yes, quantum computing is a way off and so on, and it's a long tail risk, but at some point before it happens, it will be close enough that investors will wake up and say, today's the day we worry about quantum computing, and Bitcoin and other cryptos will quickly find themselves in the toilet.
Yeah, I mean, the threat to the financial system of everything, bank accounts and everything's under pressure, but can Bitcoin really be considered to be digital gold, a reserve forever, if there's a threat there that could undermine its value?
Let's put this into a bigger perspective. We've got speculation on commodities. We've got speculation on crypto. We've got potentially a new central bank chair at the Fed coming in, maybe cutting rates. How does this feed into equities? How does this feed into the stock market? How does this feed into what's going to happen to the US dollar, which, again, will have a knock-on effect on all those things? How do you condense all that down?
a single view on three things that have been the biggest impactors from last year in the markets. That's a big one. To try to answer, let me try and split it into three ways. You've got concerns about independence of the Federal Reserve, and that's kind of put the dollar under pressure. The dollar under pressure has been one reason why international stock markets outperformed as investors look to invest overseas away from the US dollar. It's another reason why gold stepped up and other precious metals, because people are looking for a hedge against the declining dollar. And along with that, you've got too much debt from governments across the world, and you've got this so-called debasement trade. And on the back of that, any real assets that can hold their value as the amount of money is getting printed in the world. And all of those factors in total mean investors really need to find ways to protect their purchasing power of money.
Let's go into how you even start to arrive at these views. And what I mean by that is, as an analyst here, you look across everything going on every day. How do you sift through the news, decide what's important, and then start to distill, what seem like unrelated news stories into a coherent view like you just have?
Years of experience, Carl, years of experience. I've looked at markets for 30 years, give or take a bit. So they go in cycles. What's happened once before, history rhymes, it doesn't repeat exactly. So you're looking for big factors and small factors that really are impacting the investment world.
Yeah.
I'm looking to find the most important factors that are moving market prices.
Yeah. I think there's a skill that people take for granted, which is when I look across media as a whole, anyone can tell you what's going on. The skill is understanding why things have happened, and that's something that comes with experience, comes with prior context.
And most importantly, what's going to happen next.
There we go. So you've said history doesn't repeat itself, but it rhymes. Can you give us an example of where that's happened recently and how you've covered it?
The biggest transformation in markets that's been going on the last few years is AI. It's changing the world. The amount of money being spent is in the trillions, almost trillions of dollars. People compare it to the railroad and all the spending. Call it what you may. I'm not sure I totally agree with it, but there's a similarity but difference.
Yeah.
There's a lot of money being spent, except now for AI it's much more than that. So one way to think about investing is follow the money. Who's spending the money and which companies are benefiting. From my experience in Japan, I was really familiar with SoftBank. I've looked at the company for 30 years. And there you had the president and founder, Masayoshi Son, standing in the White House next to OpenAI and Oracle and president sort of standing there sort of saying, this is my baby. I want to have a seat at the table. And I had a look and everyone had given up on SoftBank. Stock was trading about 65% discount to NAV. It was cheap. And that's typical when it comes to investing. People kind of get excited about companies and they trade expensive and then they fall out of love with them again and they start to trade cheap. And at that time, SoftBank was trading cheap, but it was in the right game. And after I noticed that, I wrote a report about SoftBank saying that it looked like it could be a really interesting opportunity here. And then a few months later, as the AI trade developed, it was spending on AI data centers. And there was these new arrivals called neoclouds with like a company called Nebius. And it was like, not many people had really heard of Nebius at the time, but it was a multi-billion-dollar company and benefiting from the AI rollout with a unique sort of set of experience management and expertise of engineering that positioned them really well to benefit from this. And on the back of that, I wrote a research report talking about its outlook, its strong balance sheet, its engineering expertise. Unfortunately, it turned out to be another good investment. So that proves my point. History doesn't repeat, but it does rhyme. And there's always opportunities by following the money. You don't just follow the narrative. So, Carl, you've worked at Finimize for 8 years now. You've been there through the various journeys and development. What's the one part of Finimize work that you'd really like viewers to understand?
So I think the financial services industry overall has done a decent job at access. There's a long way to go there, but frankly, we're grading on a curve, so credit where it's due. It's even more urgent and important to improve people's access to insights, research and tools.
Yeah, I mean, so many people look at investing and they're scared and they think there's this massive barriers to entry, but it's actually so easy now for investors to access markets and invest in a passive, cheap way.
Exactly. I think the industry's done a good job of getting people onto, level 1 or 2, getting started doing things on an automated basis, low cost, low fee. And I think that's that point on access. There's still so much more to do. People don't realize how easy it is to get started. And as you move up the curve of whether it's wealth or experience or sophistication, you've got tons of people paying away large single-digit percentages of their returns to advisors and managers.
Yeah, and those fees over the course of 10, 20 years build up. I mean, if you're paying 1.5%, 2% fees over 10, 15, 20 years, that's like 15, 20, 30% of your returns going out the door to someone else. But the reality is you can find a low-cost platform and low-cost funds and replicate it yourself.
So we've heard a lot about your process at Finimize, how you produce research, how you follow the money. Can you open the door a little bit on what it's like on the institutional side at places like Schroders, at hedge funds? What's your process like there? What is it like doing research there? Yeah, shine a light on it for retail investors.
So what we do at Finimize is pick out the most important stories of the day, explain what they are and how it's impacting markets. And that's similar to a hedge fund or any financial institution. You're still following the story, but you may look at it in a different way, typically in much more detail. And that's what analysts do at Finimize when we're doing a research drop. We go into much more detail and we build a model and we understand the dynamics in more detail. And at the end of the day, everyone's looking at the same financial markets, whether you're a retail investor or an institutional, and just trying to figure out how the best way is to make money.
I've always found that, certainly when I was on the sell side, you take a company, you go through the annual report, you wrap your head around it, and the purpose of building a model was to simplify it so that I could really get to grips with what's going on in this company and what's going to happen next. And I think what's really cool about what we do at Finimize is once you do that, it's that simplified, broken down analysis that we share with everyone. Compared to when I was on the sell side, I would take that simplified analysis, dress it up, produce a 70-page report so that I could sit in front of you and show how clever I was and the bank can make a margin. We're just doing the first bit. We are simplifying and shipping. So 2 big questions on hedge funds. 1, how do they work? And 2, how should retail investors think about them?
There's so many different types of hedge funds. You've got hedge funds that are quite similar to what retail investors do, investing in single stocks over a longer time period. And then you've got other types of hedge funds which retail investors really can't relate to in a practical viewpoint. You've got high-speed algorithmic trading, which are computer generated, and that's one reason why retail investors shouldn't day trade, because they're up against machines who can process at speeds way, way much faster than the human being.
Yeah.
And obviously you've got the big macro funds as well. They can move billions of dollars every day. And retail investors can't compete with that, but it's sometimes good to know what's going on in the macroeconomic world because that can impact financial markets too.
Let's invert retail thinking about hedge funds. Do you see a world where hedge funds need to think more about retail?
Yeah, very much so. They already do. Because the reality is that retail investors now can impact share prices across markets. The best example of that is meme stocks, where retail investors get hold of a company and they shoot the valuations up way beyond what most fundamental investors would think the fair value would warrant.
And you see that with, that impacts equity hedge funds, but also the derivative universe as well, when you have the knock-on effects on options and so on.
Yeah, very much so. You've got the underlying valuation, but then for the more experienced investor, but mainly hedge funds, that option trading has picked up massively and it's been very profitable for the hedge funds too.
Russell, this has been great. Thank you. Before I let you go, I'd love to know what's the most ridiculous headline or theme you've noticed in markets this week?
I've seen so many headlines and there's been so much going on that there's a lot of headlines I disagree with. Ridiculous, I'm not so sure about. What do you reckon yours is?
For me, it's got to be this whole Anthropic Claude is going to kill SaaS. I think, everyone loves to catastrophize about, frankly, anything, and that's all well and good. But it's almost like everyone's trying to out-catastrophize each other about, all right, SaaS is dead, but also anything that has ever run on a piece of software is dead, and Anthropic's going to eat everyone's lunch and dinner and breakfast and firstborns. And it's ridiculous. It reminds me of in January 2025, investors woke up and decided that DeepSeek was the next existential threat to the AI boom and sold off a bunch of names. However, the thing that led them to that conclusion was a report on DeepSeek and how good it was and how clever it was, published in the middle of December. So investors had 6 weeks to digest that, didn't, because I guess Christmas parties be Christmas partying, and then woke up in the middle of January and thought, this thing from a month ago is actually a catastrophe. Turns out it hasn't been. And it's just the same pattern repeating itself again. You know, you said history doesn't repeat itself, but it rhymes. It rhymes pretty closely 1 year out.
Yeah, the move down in these SaaS stocks over the last few months is another example of how stocks and sectors seem to overreact to news, both on the upside and in this case to the downside.